You know, it really doesn't feel like a Friday. Things haven't felt right all week. But thankfully, we're at the end. They didn't have the founder's note for the morning edition yet, so had to ride without it. But I'm keeping my eye on things. When they do come out with it, I'll get it shared out. Look at that. As soon as I said something, they would just be a little more consistent. Now, I'm going to share the AM, but I haven't had a chance to read it. So you guys are going to get that opportunity before me. Give me just a second to get it shared out. All right. So I've got that shared. TGIF, huh? We have a lot of Fed speakers today, and we have one of my favorite strategies today. The possibility for one of my strategies. I gotta say it that way because we don't know for sure that we're gonna get the setup. Just that on a day like this, we have the potential to get that setup. And I'm gonna show you what that looks like, examples of what we want to see and examples of what we don't want to see. Me, that's always been the best way. All right, I think we're ready to go. So nothing's going to matter. What's up this morning, what's down this morning, none of that is going to matter a bit when these headline numbers come out. Any pivot point that happens to be standing in the way doesn't matter. So always something to keep in mind when we have economic data, when it's one of the big ones, is that your typical regular everyday pivot point, measured move, none of that stuff matters at all. The headline will kick the algos into gear and the algos will trade it. And that's all there is to it. Right now, a lot of the things that the algo focuses on is more of the basket, right? Not just you might see the S&P move SPY, ES, SPX. In the pre-market, it won't be the SPX, but when we get headline numbers, you might see one index move, but that doesn't necessarily mean that the algos went in and traded that one index like SPY. It can trade the basket of SPY, the names that are inside it. Algorithms are much more sophisticated than they used to be, right? So they can trade the whole thing, the whole basket. And they might short some of the basket and long some of the basket. We don't know. Obviously, companies, they keep their proprietary algorithms under close wraps. They don't want us to know what they're doing. So those algorithms don't focus on pivot points. A lot of times they look at what the data is and they extrapolate how that might hurt earnings going forward across the board or how it might impact a particular sector or industry, and then it'll adjust accordingly. Remember that the futures say for the ES, that's the June contract. It's April right now. So when you're looking at the SPX, you're looking at the index now. When you're looking at the ES, you're looking at where they think the index is going to be in June. Forward future. So the basket is more complex, or the algos and the way it trades is more complex than just a simple pivot point. So when we have a day like this, we just want to keep in mind that our pivots don't matter until after the first wave is done, right? The algos will trade, we'll get that first initial big move. Then at that point, we can do measured moves, quant levels, pivot points, and price. It'll usually behave after that. We are green in the US more from a rebound than from any sort of a bullish bias. There's still no consensus on what that sell-off was from yesterday. I've seen multiple suggestions of what it could be. Everything from rumors about Ukraine and Russia and NATO to rumors in energy, oil production, storage, costs. It's a wide range of finger pointing. The funny thing is, a lot of times you'll see places like stockcharts.com, David Keller, you'll see them talking about how we are due for a pullback, we're due for a big move, or they'll say we need a big move, we need some kind of macro event to shake loose the market because it's getting too trapped with options on each side, and we're just kind of building ourselves into a rut, sticking ourselves in a channel. And when they say that to me, the channel in my mind is like when you go to the bowling alley with the kids and you have them put the bumpers in so that the ball doesn't fall in the gutter. That can happen with price when we get the call wall and the put wall on each side, and then a ton of trading happening on the edges, and price just gets stuck in a range and we need to flush it out. So a macro event, a reversal, you'll hear analysts talk about that. Then we get a big move. Sometimes it's really obvious. Everybody points to the one thing and they say, oh, it was this that caused it. And then other times there's really not one thing to point to. But at some point, the talking heads will finally all agree on what it was. And then they'll just all say, oh, yeah, it was this one thing. The point, though, is it doesn't really matter what it is. We needed that kind of a pullback. We got it. Kudos. Cheers. Yay. Sounds a little, tinfoil hat, but we always seem to get what we need. And then they just pick something and make that the cause or the reason that we got whatever it was that we got. So we are agreeing this morning, more likely from reciprocation, a little bit of a bounce more than anything else. Hong Kong is basically flat. Europe's down 1%. Japan's down closer to 3%. They're doing better now, but I think they're up off the lows last I looked. So it's pretty rough out there. I think the only reason that we're able to even rebound a little bit this morning was because of the Fed speakers we've got today and the non-farm payrolls today. If it wasn't for that, I don't think we would have gotten our bounce yet. On the other side of that, though, once we fell yesterday, that negativity spread around the world and knocked a lot of these other markets down. We have kind of recovered a little bit, right? Not very much, as you can see with the NASDAQ up the most, about 0.5%, and the Dow up at 0.25%. So we've recovered a little bit, but they didn't. Non-farm payrolls, NFP. This is a pretty big one, all things considered. There's nothing else that's going to go on today that is bigger than that. And there has not been anything this week that we've gotten that's as big as this. So as you can see, a lot of these red bars, we're also going to get Fed speakers today, uh, all through the day, like nonstop, as it's been all week. We've had, you know, 3 or 4 Fed speakers nearly every day all week. It's just been nonstop. And a lot of them, the same ones from one day to the next, as if the story is going to change or the narrative is suddenly going to shift. So I want to kind of lay out this trade setup that we have today. We have the possibility to get this at 8:30. I call it a liquidity gap. I know you don't see a gap, you see a candle. But think of it like a vacuum and think of it as a gap. We need to get back to where price was at the start of that candle. Now, I don't care if it goes down or goes up. What I care about is that we get one single directional push. It doesn't have to be one candle, but we want one direction. Notice this thing did not go up. I mean, there might be a tiny, tiny little wick there if I zoom in, but it didn't go up. It just went down. We could have had 3 or 4 candles. That wouldn't matter as long as it kept going down. So if it went up, that would be fine. If it goes down, that's fine. We don't want a big wick. We don't want to see this drop a long ways and then run back up and close off of that low by a significant amount. How much is a significant amount, right? Well, definitely not more than half, 50%. But really, I don't like it to pull back more than even 25%. So it should be down 75% of that bar. There should be no more than 25% of a wick here. I'm a, you know, I'm willing to be relaxed on that a little bit. It's not like I'm going to measure it and say, well, it was 73 and he said 75, so we're going to throw it out the window. Just, try to use a little bit of judgment. We don't want a big wick on either side of this bar. Once the initial push stops, we look for some sort of basing pattern or topping pattern if it happened to have been on the other side. And then we focus on getting back to the target. Now, some people are going to scalp it, getting in and out, in and out, in and out, working their way back to the target because they don't want to sit and wait there for a couple hours as it grinds its way back in the right direction. Others are going to get in it and just hold on and wait for it to get there. It's not right or wrong. It's just what suits you. At this point, it's considered what I call destination trading. You know where we're going. Act accordingly. If that means you want to do TRB breakouts, then do TRB breakouts. If you want to, pick it up on the wick, then pick it up on the wick. It's whatever entry concept strategy you use that you want to use, that you like to use. We still know where we're going. We're going back to get the gap closed. Do it however you want to do it. But notice we did get the gap closed around 11 o'clock. So here's another example in the other direction. Almost no wick. Single directional push. Not much of a base or topping pattern. It just stopped. And we began working our way back to get the gap closed. We got there a little before 11, but the whole thing was done after 11. And I will point out this overshoot here, just that little bit of extra. Once it made it back to the gap fill and we got that little extra, we see that quite a bit. I should have waited until later in the day to do this picture, but it sold back off again. So we came up, we got the gap closed here. It overshot like that, and then it came right back in again. Same thing happened here. We got the gap closed, we overshot, it came back again. So here's another example. Happened to be a CPI event. single directional push. Notice there's a little bit of a wick up here. It's not perfect. It's this is a little bit of a concern, but it wasn't a big enough wick to shut the whole thing down. And the problem or the concern is once we had that first pullback and then price closed, the new candle opened, the next candle failed to get out of that candle. That's a trap. That because you don't know, well, is that what we're going to get? We're going to base here and then begin working our way down? Or are we just calling a timeout here for one candle and then continuing to the upside? You never know at the time. So, got to be aware of those pullback candles. They can cause a little bit of a false trap. But we have a nice topping pattern here, and then we began working our way towards the gap close, which we got there near 11 o'clock. It wasn't perfect, and we did overshoot, but much, much later in the day. So not the same as what we had seen previously. This is a really nasty version. This is what we do not want to see. So when it looks like this, I don't trade it. It's not to say that I don't trade at all. I don't trade this gap close play. Okay, so it's got a lot of wicks across the top. It pulled back way too much. It started aggressively trying to close the gap even before we got into the RTH open. This is not a gap close play that I want to use. So if that's the kind of setup we get, I just throw the strategy in the trash. Forget it. I don't want it. I'll trade something else. Another example of what we don't want, big wicks on each side. That is not what we're looking for. If it looks like this, there is no gap close strategy at this point. Forget it. We'll do something else. Another example of what we don't want, big wicks on each side. That's it. We don't want it. So another example, what we don't want. Imagine that, right? I have more examples of failed setups than I do of setups that worked. There's no guarantee that we're going to get it. Now, this one I actually just took this morning because somebody asked about these liquidity gaps the last time I went through this spiel. You can find the same thing happening on an intraday basis. Anywhere that you get a sudden shock and awe move with a very large candle, consider it a possible liquidity gap. Now, if you get into drop base rally and rally base rally, rally base drop, if you go through those kind of courses, they will talk about the idea of price suddenly leaving a zone very fast, these leg out candles, and how there's unfinished business, which is the way that I like to phrase it. The whole thing about supply and demand, I've noticed, just really seems to confuse newer traders, but leaving it at unfinished business kind of just keeps it less confusing. We left that zone so fast that anybody who wanted to trade there didn't get their chance, and price very often will come back to one of those zones. So this isn't a textbook version of a rally base rally, but it's pretty close. The main thing is that very large candle that offers a liquidity gap setup. So does this one up here. We left that zone very fast, creates like a liquidity gap. Price wants to go back up and get that gap filled. For the one down here, it took a while, but price went down there and got that gap filled. So you can get them intraday, and I didn't mark it, but we fell out right there. That was another liquidity gap, and price came up and got that gap filled. There was all kinds of gap fills that day. So this is a concept you'll find all over the place. But really, it fits right into the drop base rally concept or school of thought. So we get this opportunity on economic events 3 times a month. CPI, PPI, and non-farm payrolls. Those 3 are the ones that I generally look for. There's no guarantee that we're even going to get the setup. And if we get the setup, there's no guarantee that it's actually going to follow through. I don't have examples in here yet of this, but we can get the big candle and then continue going in the same direction of that big candle. It does not have to come back around and close that gap. So I don't have any of those failures in this to show you, but be aware that can happen too. So just because we get the setup, still no promise that we're going to get the gap close, because price can do whatever it wants, which it reminds us of that constantly. So that's the gap close play. Simple, easy, nothing to it, right? And for a day where we're waiting on economic data, that's a whole lot of volume for a hurry up and wait event. It's very interesting, and it's a cause for a little bit of concern. We know that they're hedging, which makes sense, right? That there's no telling which direction we're going to go. So hedging gives them the ability to hold on to what they already have without having to close out for fear of being on the wrong side. I'm not assuming that they're hedging. That's not my opinion that they're hedging. We know they are hedging because we can see the market maker move this morning. And it's a pretty good size market maker move. Our regular average daily range right now is 1%. The market maker move today says we can go an additional 0.64% on top of our regular 0.98 or 1%. So one thing that we can do with that is we can look at the ADR, average daily range, which today happens to be 5250. It's that yellow line buried into all this noise. And we would add the market maker move to that. And that would be the projection of how far we could go today. And it still wouldn't be considered a big move at that point. So just for some easy numbers, this isn't spot on perfect, but it'll get it done for us. We need 33 points, 33 and a half. From 52.50 to 52.83. Why? Because we have a 33 and a half point expected market maker move. So we could go all the way to 52.85 and it still wouldn't be considered an outsized move. That wouldn't be big. That's just another day at the park. We would have to go beyond that even more before market makers would start to consider, oh, hey, this is kind of getting out of control. It's getting a little big. On the downside, that takes us below 51.20. So 52.80 to 51.20. That's a pretty good size move for today. And it's not an either or. You'll love that, right? I'm not saying that we could do one or the other. Well, we can do both. That's the wild ride of the S&P. So keep that in mind too, right? They are hedging and they are actively trading, both. And we don't normally see that. Normally, if they're hedging, they sit out. Or if the volume's high, then they're not hedging. We normally get one or the other, not both. So that's a little interesting. We're still underneath the daily pivot point. We haven't hit it yet, so that makes it an MDP. It's a missed daily pivot. If we look at yesterday, we had an MDP until we blasted through it. So we do have one for now. I don't have it on this page, but I'm pretty sure we moved to the downside enough that we hit the S1. Oh, I guess we didn't. We didn't even hit the S1 yet this morning. We're underneath the 20-day moving average, and we're underneath the 10-day moving average. We're closer to the upper ADR than we are the lower ADR. But those kind of rules about hitting it early, what side we're on, gravity taking us there because we get too close, all of those kind of concepts kind of get thrown out the window today. Non-farm payrolls is the only thing in town. So earlier in the week, we drew out this level, and I said we really need to close above this 52.50. It doesn't look like we're going to close above that 52.50, at least not at this point. But the measurement shows we can get there easy, no problem. So we can get above it, no problem. If we don't close above that level, it does not immediately trigger some kind of bearish sell-off or anything like that. It just kind of calls into question this continuous run that we've been having. This is not quite an evening star reversal. It's not perfect, but I mean, I kind of like it as that. Sometimes, not even sometimes, a lot of times the patterns you get, they're just not going to fit in the textbook. So if we close down today, which is so far looking like that's what we're going to get, then I would really consider this an evening star reversal, which is on a weekly, a really great signal. But for the ES, it doesn't always work out as much as it does on, say, like equities, things like that. We still have the downside here, 51.81. Holding above that or closing above it would still be good for the concept that we're still in this trend. Breaking that low and closing below it calls into question this trend. We'd expect to interact with the 10, and then we would need to rise back up and set a lower high. Now imagine we need to do all of that before we can consider the trend dead. We need to set a low. We need to rise up and set a lower high. And then we need to come back down, break that low that we set, and set a new low. We need all of that before we can say that the trend is invalid. That's weeks of candles that we don't have yet. All right, with the expansion to the downside, we've managed to broaden out the profile, 10-day, 30-minute. We do have a nice shallow area here. So if the market does attempt to make that move back up, that shallow area implies that we, at the very least, we don't have a lot of this volume as resistance. There's still a lot of pivot points. There's a lot of moving averages and just all kinds of trash overhead, because all of that stuff that was supposed to be support didn't support anything. We just fell right through it. That still begs the question, since it didn't support us, will it resist us? We don't have an answer for that, but definitely want to keep them marked out. Someone was asking how to trade this yesterday. How do you trade it when it just runs in a single direction nonstop? Like what do they call it? It's one-time framing. How do you do it? Get off the chart time frame that you use, right? So the walkthrough when I teach this, this is such a simple concept that once you see it, it's like, aha, I get it. These really big candles make trying to get in and trying to trade it difficult, right? That's the problem. If your 5-minute candle is so big that you can't see anything, it may as well be a weekly candle for all of you care, right? If it's a 10-point candle on the ES, I mean that's huge. Before COVID, we had 10-point days The entire trading day wouldn't move 10 points. This thing moved 10 points in 5 minutes. Those are just really big candles. You can't do anything with it. As far as you're concerned, it's as useful as a daily candle or weekly candle at that point. So the concept here is you need smaller candles. And I know a lot of people don't want to go below a 5 or a 15 or whatever. Everybody's got a number that they don't want to go below. But if the candle that you're looking at is so big that you can't see anything in it, we're supposed to read price. That means that we have a story in these candles that we can read. But if all you have is one single candle, that's like one word in a book. That it's not going to get you very far. You need the rest of the paragraph at least. So a weekly candle, daily candle, even a 4-hour candle, 1-hour candle, these are all really big candles. And you would never attempt to trade a 4-hour candle, daily candle, weekly candle. So if your 5-minute candle is so big that it's 10, 20, 30 points, and it's just this big, massive bar, go to a smaller time frame. Go to a time frame that gives you something to read. And for me, I like tick charts, especially during events when price is falling like that. Because now I have candles and now I have something to read. Look at that price action compared to that 5-minute chart. I mean, there's actually a story being told here. Support, resistance, momentum, trend, setups, breakouts. This is actionable. I can use this. What do you do with that 5-minute chart when it's just those big bars? Hold your nose and jump in, close your eyes and hope it works? No thanks. So food for thought, right? We don't always know when we're going to get these kind of events, but we do know when we're going to get things like FOMC days on Wednesdays in the afternoon. You can adjust before you get the candles. Go to a tick chart and be ready. CPI, non-farm payrolls, PPI, you know it's coming at 8:30. You can swap to a tick chart at 8:25 and be ready for it. We are outside the box. One thing we want to do is mark out yesterday's candle and keep our eye on that halfback, which again lines up at 52.50. We get multiple levels lining us up at 52.50. It's all right. I'm okay with it, but it just shows confluence, right? And that's where the 20-period daily moving average is at. So we have that as a resistance too. We have to get back through that if we're going to get like a TRB play and run this back to the upside. We're supposed to close inside the box 8 out of 10 weeks, 80% for the S&P. Statistically, it's only supposed to be 69% of the time, but the S&P does such a good job at this that on average, it does it 80% of the time. Now you can go and count back, a whole year's worth of weeks. I generally just count back 10 weeks because it's easy math. In the last 10 weeks, how many times have we closed inside that box on Friday? If it's less than, say, 8, then we're not getting our 80%. So this doesn't mean we're going to come back inside that box today, just that the numbers would suggest most of the time we would close inside that box by the end of the day today. Just keep in mind that those statistics and those numbers, they don't have anything to do with things like non-farm payrolls, CPI, PPI, things like that. So this is the range that we had. We can already see what next week's range is projected to be. It's not set in stone yet. Throughout the day today, next week's range is going to move around all day today while we're moving. It's got a midline here, this gray line. and then of course the green and the red line. And these three are going to shift up and down as price moves, and they'll expand a little bit and contract a little bit. These lines are based on volatility. So when the volatility changes within the options chain, they're going to expand and contract. And as price moves up and down, this entire box is going to move up and down. What we want to know is, how's the volatility look for next week compared to the volatility we had this week? So far, it looks like they're pricing in a lot of volatility for next week. And it's not done yet, because this box is going to continue to grow and adapt and shift until 4 o'clock today. Actually, until 4:15 today. So if you are on a broker and you don't have these lines and you want to mark them out for yourself, you can absolutely do that. You just got to catch it over the weekend. You can't do it like Monday morning or something. Go into the options chain on whatever platform you have. Go to next Friday's options after 4:15 tonight and mark out the high and the low. Take whatever our closing price is and add whatever this number is. It'd be 103 if we were doing that right now. So add 103 to the close and subtract 103 from the close, and that'll be your high and low lines for next week. We call that a static expected move, because we're going to lock it in right there over the weekend, and we're not going to move it again. Every single day, we can come in and get a day-to-day expected move. That's dynamic. It's constantly shifting, right? So we've got dynamic expected move. It's static expected move. I did mention we were below the 10. This is the deepest we've been below the 10 since the first week in January. For the 10-day anyways. So it's nice that we're finally getting a little bit of a reset, but we're changing things, right? This dynamic that we've been in all year so far is done. Now we're into something else. And generally what that's going to mean is that we're going to see some sort of capital rotation across the board too, between growth and value and just everything. If you, have profit in trades and things seem to be kind of slowing down, and maybe you take a good hard look at what you're holding, reconsider rotating some of that capital around, closing some stuff down, taking profit. We don't know where this sector rotation or fractal rotation, we don't know where it's going to go yet. We're still 1.66 above the 10-week. We haven't been this close to the 10-week this year. In fact, it was all the way back in late October into the 1st of November with QRA when we got above the 10, and we have never been back to this close to the 10 since then. So again, things are changing. It would be pretty awesome to get a reset, to get a move all the way back to the 10-week moving average. Just remember that the 10-week very often closely resembles the 50-day. See where the 50-day is right there? It's 51.50. Now, I'm not saying it's spot on perfect, because it's not, but a 50-day is going to give you a pretty good estimate of where the 10-week is. $51.30 is what this says. The 51.50 is what the 50-day is. So not bad. 20 points off. It's close enough for me. When you're just winging it, you don't want to have to hurry up and put a bunch of indicators on. It's a good way to get it done. So we got our range. We got our perception that next week is already pricing in more volatility. We can see the reset happening with price and the 10-week. We know when the data is coming out. We've already got our extreme levels marked, that we would have to move beyond those measurements that I did before we would consider anything extreme. So as long as it's still inside of that, we're not extreme. And I'll leave you with this. One of the things about the move yesterday wasn't how far it went, because it really didn't go that far, right? 110 points or so. I don't have the exact number, but I mean, we can snap a line. It didn't go very far. That wasn't really the drama yesterday. It was how fast. So that was a 2% move, 2.19, pretty close to saying it, 2.2. It was just the pace and the speed of that move that really kind of shook some things up. And that did light volatility up. And I already started seeing a bunch of people saying, see, I told you so. Because everybody has been talking about the VIX for like, I don't know, days and days, weeks, that we were near and under this 13 level, and how, we haven't been this low in a long time, and buy it because it's really cheap, just because it's really cheap. Why not? Blah, blah, blah. And now we got a little bit of a lift, a little bit. We're into 16. And there's already a ton of people jumping up and down saying, I told you, look at the VIX. I told you. Okay, whatever. What about when they were saying it back here and here and here, and all these weeks where it didn't do anything? And this one week where it popped up and fell right back down. For all we know, this is going to pop up just like that one and fall right back down. We don't know. So I think you're about as prepared as you're going to get at this point. Wait for the numbers to come out. See if we're going to get the gap close play or not. From that, then you can come in and on your own platform and do what we normally do, right? After we get non-farm payrolls, bring up the quotes, use the watch list, set them into order, what's down the most, what's up the most, and then lay out your funnel to narrow the list down into something you want to day trade. Everybody, be careful, be safe, have a great weekend. I'll see you all next week.